QQQI looks incredible right now. High income, consistent payouts, exactly what most investors say they want. But what happens if you zoom out 10, 15, 20 years? Because what looks good today doesn't always win long term. Today we're projecting forward. We're comparing Invesco QQQ Trust, pure growth, tracking the NASDAQ 100 against NEOS NASDAQ 100 high income ETF, QQQ versus QQQI, designed to generate income using covered call strategies. We're looking at the same market exposure, but completely different outcomes. And then we take it a step further. We focus both strategies out 20 years, because this is where the real difference shows up. Not in a good year, not in a flat market, but over decades of compounding. We're going to answer, does income slow you down long term? Can QQQI keep up with QQQ over time? And what actually builds more wealth if you stay invested? Because the goal isn't just income today, it's whether your strategy still works 20 years from now. Let's open up the numbers. Welcome back to Simply Money. So today what we're doing is we're going to be looking at QQQ. We're going to look at QQQI. We're going to forecast them both out 20 years based on historical data. And then we're going to look at what happens if you combine them both. Can we get the best of both worlds? Can we get the power growth of QQQ? Can we get the income of QQQI and combine them together and get the best of both worlds? Let's see. We have our Simply Money Portfolio Planner. If you'd like a copy of this, you can get a copy down in the description below at Buy Me a Coffee. All of our spreadsheets are available there. This one here, you can do a lot of different things. What we have here is you put the ticker in. So we have QQQ and QQQI right here. You can pick up to 10 different tickers to build portfolios of different strategy percentages. So you have conservative, moderate, and aggressive. But what we're doing today is simply looking at these two individually and then combined. On the conservative model, I just have QQQ as 100%. In the moderate model, I have QQQI as 100%. And in the aggressive model, I have them 50-50. They each get half of the money. We're going to start out with $100,000 invested. We're not investing anything else. We're starting out with $100,000. And we're going to let it grow for 20 years and see which one does what, how's the growth, how's the income, and what does it look like when you combine those both. You come over here, you make sure the rules, you can set up rules on this. We're not doing any rules, but you can put up to 10 different rules if you want to add monthly, if you want to do an annual bonus, different things. You can set those up here. Then you allocate how much of that you want to go into that as well. Again, we're not going to get into that today. I have other videos that show all the different dynamic things you can do with this spreadsheet. Today, we're simply using it to compare these two funds side by side and then combine. What does it look like? We have that set up. We come over here to the forecast tab. Up here, we look at what model we're looking at. So we're going to start with the conservative. This is QQQ. And as we come down, we look at here, starting out year one, you're going to generate $50 a month of income. So obviously QQQ is a pure growth machine. It's not meant to give income. It's going to reinvest that $50, help out a little bit, but the main engine is just the growth of the underlying funds. As we come down here, we'll come down to year 20 like we do on the other videos. You can compare these to them. I've done SCHD and SCHG. We've done SPY and SPY-I. And today we're looking at QQQ and QQQI. As you see right here, it has a phenomenal growth over 20 years. At $100,000 would be almost $3.6 million. So you'd have to sell shares each year, each month, however you want to generate your income. Sell shares to generate the income you need to live off of. But that's a nice portfolio over 20 years. If you get to that $100,000, and then you just let it ride in QQQ for 20 years, this is the potential that past data shows that it could grow to. You'd generate about just under $20,000 a year, about $1,700, $1,800 a month. Again, you'd have to sell shares to be able to live off of this. This isn't something that you can just live off of the distributions and not sell shares. But If you want to come over to not selling shares and go to the income play, we come over here to the moderate. This is the QQQI model. This is strictly the income play. And see, instead of $50 a month, you're looking at $1,100 a month to begin with. Now, let's see how this does growth-wise and income-wise compared to what we just looked at. So we come down here, look at year 20. Now, obviously, the income is way lower, $1.6 million. But you're generating $200,000 a year of income. If you were to say, okay, at 20 years, I'm done. I've built up a nice portfolio. Now I'm just going to start taking these distributions. You're looking at about $18,000 a month and never have to sell a share. That's in theory. That's how, you hope it works out. Just like with QQQ, you hope it works out like the past does, and it has the same growth rate, and your portfolio would be what we showed there. But that is a nice income if you obviously need $200,000 a year, but say you only needed $100,000 a year. And you're reinvesting the other $100,000 a year, and that's going to help continue to grow your balance and give you pay raises over the course of time. But what happens if we combine both? Do we get the best of both worlds by the power growth of QQQ and the income of QQQI? This is where we need to look at this. And if you're building for the next 20 years, this decision matters more than you think. Now, I want you to look at this as we dive into this now. We're going to go to the aggressive model, and that's where we have it set up 50-50. As you can see, if you were to just put that in and start 50-50 in QQQ and QQQI, you'd have about $575 a month of income. But if you let that grow, just set it in there, let it grow, reinvested all distributions back into it, the end of 20 years, we'd be looking right here at almost $2.6 million. So way better than just QQQI and still significantly lower than QQQ. But you'd be generating $166,000 of income. You would still have the power of the growth and some income. You'd never have to sell shares, and you could get $165,000 a year. Or you could do like in the other scenario, I need $100,000, reinvest the $65,000. And you're getting the growth of QQQ still. You have the income of QQQI and reinvesting a large amount of the distribution to build that fund even more. And that's where it's a nice combination for those that don't want to be selling shares. They just want their portfolio to grow, but they still need income. So there's different scenarios, and this is a good time to stop. This is not financial advice. This is for informational and educational purposes only. Please do your own due diligence and know that all investments come with risk. I'm showing you this just to show you the power and the possibilities of combining two funds. I like combining. If you've watched my channel, you know I share a lot of my income portfolio. I don't share a lot about my growth portfolio because its purpose is just to sit there and grow, and that's what it's been doing. I've shown a video on SCHG before. I've shown the growth power of that. But I have that portion just growing. It just sits there and compounds year over year. And when I go to retire, whatever that day is, and I say, you know what, I'm going to start using the income portion, I'll take that income out. I never have to touch my growth. If I do need to, I can just transfer some into my income portion and boost my income, or I can sell some if I decide to do that way, or I can leave a legacy for my family. All sorts of options, and everyone's going to have to make a decision based on what their risk tolerance are, what their goals are. Why do you want this? Some people want to retire and then their goal is die with zero, and that's fine. Other people want to make sure they leave a legacy for their kids. I have one client I work with. He wants to build a living legacy. He doesn't want to die and leave it to his kids, but he wants to be able to have the money while he's alive and work with them and give them gifts and help them out with buying a house, whatever the case might be, and have that legacy while he's living, having enough income and growth happening simultaneously. So that is the power of what you can do when you combine both of these. And you could look over here in the rules and you could add what happens if, okay, I put this certain amount. Maybe start with $10,000 in each, and then you add 100 or 200 to each per month over 20 years or 30 years. So you can play with this and get different ideas of how it would grow and how it would develop based on prior data. So that is QQQ and QQQI. What are your thoughts? I do own QQQI. I own a little bit of QQQ. My biggest growth fund, for those that may be wondering, is SCHG. That's my own personal opinion, my own preference. It's done very well, and it combines well with my SCHD and then my other income players that I have. But this is QQQ and QQQI. Give me some comments. Do you like these videos of comparing one and the other in the combination, or do you want to see more of something different? If you have suggestions on some you'd like to see, throw those in the comments below. I appreciate you joining me, and we'll see you next time on Simply Money.